This is the second video on chapter 13, and I will start with table 13.1. You should be able to do some calculations from the table. They give you an example of a tax of 220,000, income of 220,000. So let's do another example so that you have two examples to work from. How much tax will a person pay who earns 400,000? So the first thing that you do is to go and look at the taxable income bracket. In which bracket does 400,000 lie? It lies between 305 and 423. So the person will pay the basic amount of 63,800 plus the marginal rate, which is 31% of everything above 305,851. So you take 400,000 minus 305,851. That is the amount of money that no tax has been paid on. So on the 305,851, the person pays 63,853 plus what you earn extra is taxed at a marginal rate of 31%. And after you have calculated that amount, then you subtract constant rebate, which is 14,000 something, which was 14,000 something in 2019-20. They give it to you in the table. So make sure that you can do some calculations using this table. So the next part and the final part of this chapter is on the economic effects of the tax. So the first is economic efficiency, and what you should always remember is economic efficiency has to do with excess burden. So how big is the excess burden? We've seen earlier in the previous chapter that a general tax is better than a selective tax on consumption, and now we will also show that this is true for a labor tax on labor. So since leisure cannot be taxed very easily, a tax on income is actually in fact a selective tax. So suppose your tax rate increases and you decide to work less. That means you have more leisure, but then that leisure is not taxed. So one always has a choice between working and not working. So efficiency is excess burden, and you have to remember that how leisure works. So let's look at a graph. 13.1 is really important. I've repeated in the box, since leisure cannot be taxed easily, a tax on income only. If you only tax income, then we basically have a selective tax. So do you remember from economics 2 to 4, those of you who had 2 to 4, if we look at the horizontal axis, then we could either show work from right to left. Let's say point L refers to a certain number of hours. I think the textbook talks about 18 hours. The rest is just sleep. So let's say you have 18 hours and you can decide to work 18 hours or work nothing and have leisure of 18 hours. So we measure work from right to left, and we measure the amount of leisure from left to right. So at the blue dot, that means the person doesn't work, so the income on the vertical axis is 0. While if the person works 18 hours, then the potential income is the whole vertical axis up to the blue dot on the vertical axis. So the more you work, the more income you can get. And the rate of the slope of that budget line between the blue dots is the wage rate, if there's a constant wage rate. So let's say the government taxes income. That means the person can earn less. Now this looks like a severe tax because before she could get to the blue dot on the vertical axis, and now she gets much less than that if there's a tax on income. So can you see that now the person will only be able to reach utility level 1 at point E1. So the tax on income reduces welfare for the consumer. But what is now very important is to see by how much, what is the effect on work. That's the point in this graph. If we compare points E0 and E1, can you see that at E1 the person consumes less leisure, Q1 amount of leisure, than at Q0. So why is that? So the person is taxed on income and then decides to work more. Remember, we measure work from right to left, so the person decides to work more up to point E1. Well, there's an income effect and a substitution effect. So let's get the two effects, the income effect and the substitution effect. The substitution effect is gotten by moving from the original equilibrium point E0 on the same indifference curve. Substitution effect is always on the same indifference curve. So can you see that line HJ is parallel to line BL? So that's the new budget line. So we draw a construction line parallel to the new budget line, tangent to the original indifference curve, so the tangency point is at E2. So the substitution effect means that the person moves from E0 to E2. What does that mean? It means consuming more leisure. Consuming more leisure. And that's the point, because leisure is not taxed. So if income is taxed, it means income becomes harder to earn. It becomes in real terms more expensive because leisure is free. So leisure now becomes cheaper because it's relatively cheaper than going to work, and the person then chooses to move to E2. But the income effect, now the income effect is the movement from E2 to E1. That dominates in this graph because the person still wants to maintain a certain level of consumption. She earns less, but wants to retain consumption, and therefore she has to work harder to be able to at least keep some of her consumption levels up. We could have drawn this graph obviously in any which way we want. We could have let E1 be at that blue point, that one, and that would have meant that the substitution effect dominated and not the income effect, and in that case the person would have chosen to work less as a result of the tax. So the point, what is the point? The point is the amount of work offered could be influenced by the tax, depending on the strength of the income and the substitution effects. Behavior could change, and this has to do with efficiency. So because it's not a general tax but a selective tax on income, it's inefficient. Because behavior can change. Behavior in the sense of, as a result of the tax, the worker can decide to work more or less, depending on the effects. Figure 13.2 tells the same story, and we had this exact story when we compared a general tax on consumption to a selective tax on one of the goods. Now this graph shows, I don't know how many of you spotted this, but this graph is exactly the answer to homework 8. If the axis would be y and x. Well, this is exactly the graph that you should have drawn. It's the same analysis as in figure 12.1, so I'm not going through the analysis again, but it shows that the parallel shift is like a general tax, and the swivel from y to b is the proportional tax on personal income, and that's always worse than a general tax, which would have taken you from E0 to E2, but now it takes you further down, so there's a bigger excess burden or a bigger welfare loss if you have a selective tax on income. Now, what about the effect of an income tax on savings? Figure 13.3. So this is all. This also has an effect on the efficiency, because remember that we have a sources side of tax and the users side of tax. The savings is part of the users of income. So what would happen if we tax the return to savings? I will do this, I will start with this then in the third video.